Welcome to Tech Money Madness, your daily U.S. stock market podcast, April 20th, 2026.
Yeah.
And today we are extracting the most critical insights from the day's market briefing for you. Because, today's one of those days where the United States government is actively pulling levers to drain money out of the economy to fight inflation.
Right, tightening the belt.
Exactly.
Yeah.
But simultaneously, they're preparing to hand billions of dollars in cash directly to massive retail corporations like Walmart and Target.
It is a totally brilliant, messy, entirely accidental paradox.
It really is. So welcome to this deep dive. Our mission today is to make sense of all this for you, because if you just glance at the surface numbers today, you would think the market is completely asleep.
Yeah, totally flat.
Right. We're seeing incredibly cautious trading across the board. The major indexes are functionally flat. The S&P 500 and the Dow are, barely eking out minor gains. And the Nasdaq is sitting with a slight decline.
Yeah, it looks like a whole lot of nothing to the untrained eye.
Right. It feels completely stalled out.
Well, it has all the traditional hallmarks of a market that is just holding its breath. The trading volume is hesitant, capital is hiding in defensive sectors, and institutional investors, they're just sitting on their hands.
Yeah, nobody wants to be the one to make a mistake.
Exactly. Nobody wants to make the first major move when the underlying environment is, this fragile.
But the moment you look beneath that flat surface, the undercurrents are massive. We are looking at a day defined by those billions in sudden government refunds we mentioned, plus a frankly mind-boggling $100 billion artificial intelligence cloud commitment.
That number is still crazy to me.
It's insane. And on top of all that, the official end of an era at the world's most famous tech company. So, okay, let's unpack this, and let's start with the macro picture.
Sounds good.
Because the primary driver of this market, caution today, it isn't a lack of capital to invest. It's a violent surge in the energy sector.
Yeah, driven entirely by geopolitics.
Right. The briefing today specifically highlights escalating tensions between the U.S. and Iran, with the U.S. actively threatening action against Iran if a new deal isn't signed. And the market is just, they're pricing in that risk immediately.
Oh, without a doubt. And to understand why a standoff with Iran effectively freezes global markets, we have to look at how energy acts as the fundamental baseline cost for the entire global economy.
It touches literally everything.
It really does. When geopolitical tensions threaten the Strait of Hormuz or, broader Middle Eastern supply lines, oil and gas prices don't just gently drift upward.
No, they spike violently.
Exactly. And a spike in energy is essentially an immediate, unannounced tax on every single good that exists.
Wow. Yeah, that's a great way to put it. An unannounced tax.
Think about it. If you manufacture a plastic toy, the petroleum feedstocks cost more to make the plastic. If you ship that toy across the ocean, the bunker fuel costs more.
And if you put it on a truck to Ohio, the diesel costs more.
Right. It ripples through the entire supply chain instantly. And that erodes corporate profit margins across the board.
Which makes today's briefing so tense, because this geopolitical threat is colliding violently with our domestic monetary policy. And that brings us to Kevin Warsh.
Yeah, the man of the hour.
Right. He's the nominee to lead the Federal Reserve, and he is making major headlines today, because he is doubling down on fighting inflation and aggressively defending the independence of the Fed.
Very aggressively.
Yeah, the specific quote that jumped out at me from the sources is his statement that the Fed must, quote, stay in its lane to maintain that independence.
Stay in its lane, yeah.
If the stock market is a driver, right, cautiously tapping the brakes because of this massive geopolitical roadblock ahead, then Kevin Warsh is like the driving instructor in the passenger seat, just yelling at you to strictly stay in the lane and ignore the political noise outside the car.
That analogy actually hits the nail on the head regarding the mechanics of monetary policy right now. Because let's break down what Warsh actually means by his hawkish stance.
Yeah, let's do it.
So the Federal Reserve controls interest rates. When they raise those rates, they're intentionally making it more expensive to borrow money.
Mortgages go up?
Right. Mortgages go up, corporate loans get pricier, and credit card debt becomes, crippling for a lot of people.
Yeah.
The goal is to drain liquidity from the system, like literally taking money out of circulation so that you, the consumer, buy fewer things. And when demand drops, companies are forced to lower prices, which cools down core inflation.
But Warsh is drawing a very aggressive line in the sand here.
Yeah.
Because the Fed's tools, they only work on the demand side.
Exactly.
You can't print more oil. You can't lower interest rates to magically fix a geopolitical standoff in the Middle East.
No, he can. And that is the crux of the tension today. Warsh is signaling to the markets and to the political establishment that even if energy prices surge and cause massive economic pain for everyday citizens, the Fed will not step in to save the day.
Wow.
Yeah. He is preemptively rejecting any future pressure to lower interest rates just to offset the pain of higher gas prices.
Right, so by emphasizing that the Fed must stay in its lane, he's committing strictly to fighting core inflation.
Ignoring the political fallout entirely.
That is an incredibly tough pill for the markets to swallow.
It is. Capital is basically just waiting right now to see which force ultimately breaks first. The geopolitical inflation shock or the immovable Federal Reserve.
It is a massive macroeconomic tug-of-war. But what is so fascinating about today's briefing is that while macro policy and global tensions are dictating this sort of paralyzed broader mood, specific government policies at home are simultaneously creating massive windfalls for individual sectors.
Oh, absolutely.
Like, total out of left field, we have a major economic data point today. The U.S. government just officially launched its claims filing portal for tariff refunds.
Yeah, and I know on the surface, claims filing portal sounds like the most tedious bureaucratic update imaginable.
It really does. It sounds like something you'd ignore in an email.
Right. But we are actually talking about a potential goldmine here. Billions of dollars in retroactive refunds are about to flow directly back into the pockets of massive importers.
We are talking about companies like Walmart and Target.
Exactly. They stand to recoup astronomical sums of money.
I want to pause in and just look at the sheer friction here, because this brings us back to that paradox I mentioned at the top of the show. We just established that Kevin Warsh and the Federal Reserve are trying to cool down inflation by keeping money tight and making borrowing painful.
Right.
So doesn't handing billions of dollars in cash refunds right back to massive retail giants like Walmart act like a giant accidental stimulus check? Are these two government forces pulling in exact opposite directions?
It absolutely acts as a stimulus for those specific corporate balance sheets.
That is wild.
It really highlights how trade policy and monetary policy operate on completely different timelines, often completely blind to one another.
So how did we even get here?
Well, let's walk through the actual life cycle of a tariff to see how this happened. Years ago, tariffs were implemented as a blunt geopolitical instrument, a trade war tactic. But foreign countries don't pay tariffs.
Right, American importers do.
Exactly. So 5 years ago, let's say Walmart had to pay an extra 20% tax at the port just to import a blender.
But Walmart isn't going to just eat a 20% loss on their margins. They'd never do that.
Never. To protect those margins, Walmart simply raised the price of that blender on the shelf by 20%.
Oh, so you, the consumer, ultimately paid the tariff.
Precisely. And that price increase directly contributed to the broad inflation that the Federal Reserve has spent the last few years aggressively fighting.
Okay, but now the script is flipping.
Right. After years of legal and bureaucratic wrangling, the appeals processes have concluded, exemptions have been granted, and this new portal is basically the mechanism for making those retail companies whole.
Yes. So Walmart is going to log into this portal, file their paperwork, and the government is going to hand them back that 20% tax they paid at the port years ago.
Yep.
But Walmart is certainly not going to mail you a refund check for the blender you bought in 2021.
No, absolutely not. That refund goes straight to their bottom line as pure profit margin.
That is incredible.
Yeah, the trade authorities, they aren't looking at the current inflation rate. They are just executing the legal conclusion of a policy from years ago. So the Federal Reserve is aggressively trying to drain liquidity while the trade authorities inject billions into the retail sector.
It perfectly illustrates the multi-layered, totally contradictory environment these businesses have to navigate daily.
Yeah.
The left hand has absolutely no idea what the right hand is doing.
Not at all.
But, while traditional retail is looking backward to recoup past costs via these archaic tariff battles, the tech sector is doing the exact opposite. They're throwing unprecedented, historical amounts of capital strictly into the future. Let's pivot to the most active stocks of the day, because the tech arms race is just going nuclear.
It's fascinating to watch.
Amazon is sitting as one of the top gainers today after announcing a massive investment in the AI company Anthropic. But the headline number isn't just Amazon's initial investment, it's the reciprocal commitment.
Yes.
Anthropic is officially committing to spend over $100 billion with a B on Amazon's cloud services over the next decade.
I mean, the scale of the capital moving in the tech sector today requires a total recalibration of how we think about corporate spending.
Seriously.
In retail, they're fighting over historical refunds, but in tech, they are signing century-defining infrastructure contracts.
The mechanics of this Amazon and Anthropic deal are wild.
Yeah.
It's like Amazon is buying a controlling stake in a world-class restaurant. But as a condition of the sale, the head chef is signing a legally binding contract to eat every single meal at that exact restaurant for the next 10 years.
Yeah.
To the tune of $100 billion. I mean, it makes me deeply skeptical of the accounting here. I have to push back a little. Are these tech investments genuinely about advancing artificial intelligence, or are they just massive closed-loop systems designed to lock in captive cloud customers and inflate revenue numbers?
Well, what's fascinating here is that you really cannot separate the advancement of AI from the monetization of the cloud anymore. They are one and the same now.
Really?
Yeah. To understand why Anthropic would commit $100 billion to Amazon Web Services, you have to understand the physical reality of artificial intelligence.
Okay.
AI is not just software floating in the ether. Training a foundational AI model requires tens of thousands of highly specialized graphics processing units, GPUs running at maximum capacity.
24 hours a day.
Exactly. For months on end, it consumes enough electricity to power small cities.
So compute is the oxygen for AI. Without server farms, the algorithms basically suffocate?
And Amazon owns the server farms. Right. So by investing heavily in Anthropic, Amazon is ensuring that the next generation of AI breakthroughs happens on their proprietary servers. But that $100 billion cloud commitment, that is the ultimate moat.
They're locking it down.
Yeah, Amazon is effectively locking in the demand side of the equation for a decade. They are guaranteeing that their massive capital expenditures on data centers will have a paying tenant.
That makes a lot of sense when you frame it as real estate.
And if you look at the Google and Marvell deal from today's briefing, it's the exact same dynamic, just one layer deeper in the physical hardware stack.
Right, because Marvell is surging as a top gainer after securing deal to help Google build custom AI chips. And that specific deal directly caused Broadcom, a major chip competitor, to become one of the day's top losers.
Yeah, because Google doesn't just want to rent cloud space from someone else. They want to own the physical architecture of the silicon itself.
So what are they actually building with Marvell?
Google is partnering with Marvell to build what are called ASICs, application-specific integrated circuits. And to understand why the market reacted so violently to this, think about the difference between a standard chip and an ASIC. A standard chip, like the ones Broadcom specializes in providing for general networking, is like a Swiss Army knife.
It can do a little bit of everything.
Exactly. It does everything pretty well. But Google doesn't want a Swiss Army knife to train their AI. They want a highly specialized, laser-focused scalpel that only does one specific mathematical calculation perfectly.
Right, because when you are operating at the scale of Google, running trillions of calculations a second, a chip that is even a fraction of a percent more efficient saves you millions of dollars.
Tens of millions.
Just in electricity and cooling costs.
Exactly. And that is the mechanism driving the stock price today. Off-the-shelf silicon is no longer good enough for the scale of AI these mega corporations are building.
It's just too inefficient.
Right. They need bespoke silicon optimized perfectly for their proprietary algorithms. Marvell winning that contract is a massive validation of their custom silicon design capabilities.
And Broadcom plummets because investors realize the era of one-size-fits-all hardware is ending.
Yeah. The real war in tech right now isn't just about who has the smartest chatbot. It is a brutal, capital-intensive war over physical infrastructure and silicon dominance.
It feels like the entire tech sector is gearing up for war. But executing these decade-long $100 billion infrastructure campaigns, I mean, that requires a very specific, aggressive kind of visionary leadership.
It definitely does.
Which brings us to the biggest changing of the guard in the entire market today. Apple has officially announced a major leadership change. John Ternus is succeeding Tim Cook as CEO.
A huge moment.
Massive, while Cook transitions to the role of executive chairman. And the briefing specifically notes that Ternus is expected to bring a, quote, new perspective to the company.
Yeah, the timing of this succession is definitely not a coincidence. I mean, Tim Cook's legacy as the master supply chain operator is completely secure.
Oh, absolutely.
He was the logistics wizard who took Steve Jobs' product vision and scaled it into a multi-trillion-dollar global empire.
He flawlessly navigated trade wars, global pandemics, and massive supply chain disruptions. And he did it by optimizing the manufacturing of the iPhone down to the microsecond.
He really did. But the skills required to optimize a global smartphone supply chain are fundamentally different from the skills required to win an AI arms race.
Right. With companies dropping $100 billion on cloud computing and designing custom silicon from scratch, it feels like Turnus is being brought in as the wartime general,
Yeah.
to fight a battle that Tim Cook simply wasn't built for.
Yeah, the market is increasingly viewing artificial intelligence not as a neat new feature to add to a phone, but as a fundamental platform shift.
On par with the invention of the internet itself.
Exactly. By elevating Turnus, who has deep roots in hardware engineering and fundamental product design, Apple is signaling a massive pivot.
The era of simply optimizing profit margins on the iPhone is ending.
It has to end. They need that new perspective because a highly competitive, brutally expensive product innovation cycle is beginning. They have to build the hardware of the future, not just iterate on the hardware of the past.
When I look at Apple making this massive shift, and then I look at the rest of the market from today's briefing, like Eli Lilly and American Airlines, it seems like everyone is suddenly forced to make an extreme, zero-compromise bet on the future.
Yes.
No one is playing it safe anymore. Over in the pharmaceutical sector, Eli Lilly is a top gainer today after announcing a massive $7 billion deal to acquire the cancer drug maker Colonia.
Right.
And on the flip side, American Airlines is one of the top losers today after they flatly dismissed rumors of a potential merger with United.
These look like three completely unrelated stories, right? You have tech succession, pharma M&A, and airline consolidation.
Yeah, they sound totally disconnected.
But they share the exact same underlying market psychology. In a cautious, high-tension market, remember that flat, paralyzed surface we talked about at the beginning?
Yeah, the market holding its breath.
Right. Well, companies are being forced to define their next decade right now. You can't just tread water. Eli Lilly could easily rest on the massive revenues from their current portfolio of weight loss and diabetes drugs.
They're making a fortune there.
But instead, they're deploying $7 billion to acquire Colonia. They're aggressively buying growth, utilizing today's capital to plant their flag in the oncology space for the 2030s.
While American Airlines is doing the exact opposite, but equally decisively.
Yes.
American Airlines shutting down merger talks with United is a definitive strategic choice to just fly solo.
And we can connect that choice directly back to our opening discussion about macroeconomics.
Oh, right, the energy price.
Exactly. Oil is an airline's single biggest variable cost. With U.S.-Iran tensions threatening to spike jet fuel prices to historic highs, the traditional playbook for an airline is to merge.
Right, because consolidation gives them pricing power to pass those fuel costs on to passengers.
And it creates massive operational efficiencies.
So by rejecting the merger, American Airlines is essentially telling the market they believe their internal balance sheet is strong enough to survive an oil shock without a life raft.
And the market punished them for it today, making them a top loser. Primarily because investors usually love the immediate stock premium a merger brings.
Yeah, investors want that quick pop.
Exactly. But American made a definitive choice. Whether it's Apple changing its commander-in-chief, Eli Lilly buying its next blockbuster pipeline, or American Airlines refusing to consolidate in the face of rising costs. These companies are making their foundational bets for the next era.
Pulling all of this together for you, what a wildly complex picture today paints. We started by looking at a market that seemed totally paralyzed, cautiously navigating the immediate macro threats of U.S.-Iran geopolitical tensions, and a Federal Reserve nominee, Kevin Warsh, aggressively pledging to seize the gears of the economy to fight inflation.
Stay in its lane.
Right, stay in its lane. But beneath that paralysis, the actual mechanics of the future economy are being bolted into play.
Yeah, they really are.
We have Walmart and Target preparing to absorb billions in retroactive tariff refunds, highlighting the bizarre friction between trade policies that inject cash and monetary policies that drain it.
We have the tech titans making bets so large they reshape entire industries. Amazon locking in Anthropic for $100 billion in cloud spend to ensure their server farms are the bedrock of the AI revolution.
And Google tapping Marvell to build custom silicon scalpels because standard chips are no longer enough.
And Apple finally turning the page on the Tim Cook supply chain era to prepare for a completely new hardware reality.
It is a powerful reminder for you as a student of the markets. The days of cautious trading on the surface are very often the exact days when the biggest players are quietly placing their most aggressive, decade-defining bets.
The macro environment dictates the mood of the market today, but micro-level execution dictates who survives tomorrow.
And it leaves us with one final, frankly massive question to mull over. We've talked about Anthropic committing $100 billion to Amazon, and companies like Google scrambling to build custom chips just to keep up. As we enter this new era, who actually holds the ultimate power in our future economy?
It's a great question.
Is it the brilliant minds and software engineers writing the code that creates artificial intelligence? Or is it the mega corporations that own the physical infrastructure, the custom silicon, and the massive server farms that the AI needs to merely survive? Are we watching the rise of AI, or just the ultimate entrenchment of the cloud landlords? Think about that next time you dive into the markets. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.